Okay, now we will begin the Ute series. We're up to payroll deductions. We're getting closer to the end of taxes.
In the past couple lessons, you learned how to calculate how much money you owe from income taxes each year. Don't tell your friends you know how to do this, or else they will want you to do their taxes too. But when you actually do these calculations, you might be a little caught off guard as to how high the amounts seem to be. Well, one thing that a lot of people forget about tax brackets is that they only show you how much total tax liability you have. But the actual amount that you're on the hook for is usually a lot lower. In fact, it's pretty common to not owe anything for your taxes. Or, better yet, actually get money back from them instead of having to pay. In this lesson, we're going to learn about two types of payroll deductions: pre-tax deductions and payroll taxes. And we'll take a look at how they work and how they can affect your tax bill at the end of the year. Let's get into it. We are so close to being done with learning how to file your own taxes. But first, we should rewind. We need to go back in time. Oh, no, too far. Go back. We have to go back to when you first started earning the income that will eventually be taxed. Your first paycheck of the year. You earned your paycheck through hours and hours of sweating down in the coal mines or whatever your job is. But when you get your paycheck, you won't have all the money that you earned. Some of that money was taken out of your paycheck, but for a very good reason. Several good reasons, actually. A payroll deduction is when money gets taken out of your pay before you receive your paycheck. There are multiple different types of payroll deductions. Pre-tax deductions are the first things that get taken out of your paycheck. These are to pay for certain employee benefits, like healthcare or retirement plan contributions. They're called pre-tax because they come out of your paycheck so quickly that your poor W-2 tax form doesn't even know the money existed in the first place, which means that your taxable income will be lower when you go to file your taxes. Let's say you've got a really good job where you earn $10,000 every month. If your health insurance costs $127 a month and you contribute $800 a month to your retirement plan, how much of this month's pay will be reflected on your W-2? Pause and take a moment to answer. After these pre-tax deductions, your paycheck for the month will drop to $9,073. Alongside your pre-tax deductions, you'll also be paying payroll taxes. Payroll taxes are taxes that you pay through your company's payroll system before they send you your paycheck. You might notice a tax on your pay stub called FICA. This stands for Federal Insurance Contributions Act, the law that mandated Social Security and Medicare tax contributions from nearly all working Americans. These taxes take 6.2% and 1.45% of your income, respectively. Payroll taxes also include income tax withholding, which is extremely important. Income tax withholding is money your employer removes from your paycheck before paying you and sends it directly to the government in your name to help pay your income taxes. When you first get hired, your employer will have you fill out a W-4 form, also known as an employee's withholding certificate. This gives your employer enough information to estimate what you'll owe in income taxes at the end of the year, so they'll have an idea of how much to withhold from each paycheck. The problem is, this is only an estimate. Your employer has no way of knowing what adjustments you'll claim or whether you're going to take the standard or itemized deduction, so they may withhold too much or too little. back to that paycheck from before. In addition to pre-tax deductions, we also have to account for payroll taxes. FICA taxes will take a combined total of 7.65% of your gross income, or $765, and from the information on your W-4, your employer has concluded that $1,040 should be withheld for income taxes each month. How much pay will you actually be taking home from this paycheck? If we subtract pre-tax deductions, FICA taxes, and tax withholding from your gross pay, you will still be taking home a total of $7,268. Not bad. Now let's fast forward to the end of the year where it's tax filing time and find out how much you owe. You do all the math and you find that your tax liability is $9,760. That sounds like a massive amount, and you might stress out because you don't have that much saved up. But remember, you've withheld $1,040 each month for a total of $12,480 over the whole year. You've already paid more than you owe, so you don't owe any more money. This is the part where most taxpayers start to jump for joy because they've just earned themselves a tax refund. That means that you overpaid your tax withholding. So when it comes time to file your taxes at the end of the year, you will actually be getting that excess money back from the government instead of having to pay more. Don't get too comfortable though. While tax refunds are pretty common, they don't always happen. In fact, the opposite can happen too, where your tax withholding was too low and you'll end up having to pay more to make up the difference. Even then, your tax withholding is still a huge help. Going back to those previous examples, let's say that your tax liability was actually $13,000. With $12,480 in tax withholding, that will bring your tax bill down to a much more manageable $520. To summarize, having an employer take money out of your hard-earned paycheck might seem a little sketchy at first, but it's actually for a very good reason. Pre-tax deductions pay for things that you were going to pay for already, but it makes that money non-taxable. And payroll taxes include things like the 7.65% FICA tax, as well as income tax withholding, which can dramatically lower your tax bill. Before we go, I want to give you one word of caution. If you're self-employed, there is no such thing as a payroll deduction because you're not on a company's payroll. Instead, you are going to have to intentionally set money aside to pay for things like health insurance, a retirement plan, and FICA taxes. In addition, you are going to have to send in income tax withholdings every 3 months. As I've said before, it takes a lot of financial discipline to be self-employed. Now, after your wrap-up and assessment, we are going to be taking a step back from the math side of things for a bit, and instead taking a look at the language side of it. Have you ever read a tax form? There's a lot of complicated words and confusing phrases and things in there. So I'm going to give you a big vocabulary lesson. That way you will be able to understand what's going on when you do your tax forms at the end of the year. See you then.
So we're going to go straight then to tax form terminology and learn that vocabulary next. Once it loads. And we get rid of the ads.
Doing the right thing has always had...
Hey there, it's Justin again. At this point, you know a ton about how taxes work and the math needed to calculate them. But what nobody tells you is that the math is only half the struggle. Tax forms use a lot of complicated terminology, and you're not going to get very far with your taxes if you can't read the directions. So get ready, because you are about to have a major vocabulary lesson. By the end of this lesson, you will be able to define and explain most terminology used on income tax forms. First, we'll review all the most common tax forms that you might have to deal with while filing your taxes. Then you'll learn a bunch more terminology used on those tax forms. Finally, to help you study these terms, your notes will contain a vocabulary matching activity. Let's get into it. So before you can learn tax form terminology, you should know that there are lots of different tax forms with different purposes. You've already learned about a few of them, like Form W-2, known as a wage and tax statement, which is kind of like a receipt from your employer detailing all of the money that they paid you and withheld for you over the last year. You receive this from your employer shortly after your final paycheck of the year. There's also Form W-4, or Employees Withholding Certificate, which you'll fill out when you start a new job or if you have a major change in your life that will affect your taxes, like getting married. The W-4 gives your employer an estimate of how much income tax they should withhold from your paychecks. And speaking of income taxes, you will definitely have to know about Form 1040, the individual income tax return, which is the main form that you will use to file your income taxes with the Internal Revenue Service, the U.S. federal agency that administers tax law and collection of income taxes. They are also known as the IRS. Form 1040 also includes a lot of schedules. These are additional forms that Form 1040 will ask you to complete if you meet certain circumstances. There are a ton of other forms too, like the 1099 series, which are kind of like W-2s, but for income made outside of employment. There's the 1099-NEC for non-employee compensation, if you made money as a contract worker rather than as an employee. Or the 1099-INT if you made any interest income over a certain amount. Or the 1099-MISC for if you made money in miscellaneous ways that don't really fit any of the other forms. There are over a dozen of these kinds of forms, but don't worry about knowing all of them. Any institutions you gained income from should automatically send you the appropriate 1099 form when it's time to file your income taxes. On a similar note, 1098 forms are for certain expenses that may be tax deductible. The regular 1098 is used if you paid interest on a mortgage. Other 1098 forms cover other expenses, like the 1098E for if you paid on student loan interest, or the 1098T if you paid tuition to a college or a university. When it's tax time, you can collect these documents from their respective institutions that you've been paying these expenses to, like the lender that you pay your mortgage to. But that's enough about forms. When you fill out or attempt to read these various forms, you'll find that they use a lot of terminology that you don't hear every day, unless you're an accountant, which I doubt you are since you're taking this course. So, when you first start to fill out your tax return, you will be asked for your filing status. Filing status is just a reflection of your marriage status and other life situations that will impact your income and taxes. There are 5 filing statuses. Single, meaning that you're not married and you're filing taxes only for yourself. Married filing jointly, which means you and your spouse are combining your tax returns into one. Married filing separately, if you and your spouse want to keep your taxes separate. Head of household, if you are unmarried but you have family members like children who rely on you to support them. Or qualifying widow or widower, if your spouse has unfortunately died in the last few years but you still have a child to support at home. In addition to filing status, you will also be asked to claim any dependents. Dependents are people who depend on you for financial support. Your paycheck pays for their food, their clothes, and whatever else they need. Oftentimes people mistake this to only mean the children that you provide for, but it actually goes way further than that. Dependents can also include grandparents, siblings, or even a friend who's out of work, although the requirements for claiming a friend are pretty strict. The key for who counts as a dependent is that they depend on your income for survival. On your tax return, you may need to declare capital gains or losses from buying and selling assets, like real estate or stock. Depending on how long you owned the assets before selling them, your capital gains will be considered short-term or long-term. If you own the asset for less than a year, it's considered short-term, and long-term is, of course, anything more than a year. Whether your gains were short-term or long-term will change how they're taxed. Short-term capital gains are taxed as part of your gross income, and they may raise your tax bracket for the year. Long-term gains, though, are taxed separately, at generally lower tax rates than the rest of your income. If you own your own business, or if you're self-employed, you might be able to deduct business expenses from your taxable income. A business expense is any money that was spent maintaining or improving a business. If you intend to deduct business expenses on your taxes, you should keep any receipts so that you know exactly how much you spent. Along those same lines are charitable contributions. If you donate to charities, those donations may be tax deductible. Not every donation counts, though. So if you're considering making donations, be sure to check the list of qualified organizations on the IRS's website. You may also qualify for exemptions. Exemptions are amounts that can be subtracted from income. They're similar to deductions, but with less specific requirements. Each taxpayer gets a personal exemption, plus an additional exemption for each of their dependents. The amount of each type of exemption changes from year to year, and unfortunately some years it can even be reduced to nothing at all. You might also qualify for tax credits. Tax credits are amounts that you can subtract directly from your tax liability, making your bill smaller and maybe even boosting your refund. Federal and state governments provide these as incentive to do certain things, like installing solar panels on your home or adopting a child. We've covered a lot of tax terminology in this lesson, in addition to all of the tax terms that you learned from the prior lessons. It can definitely be a lot to handle, but I don't expect you to memorize all of these definitions and details. Instead, you can find yourself a handy-dandy tax terminology dictionary in the notes for this lesson. Use this dictionary to help you out with this course, and then put it somewhere safe so that you can use it whenever it's time to do your own taxes. With everything that you've learned so far, you will be able to save yourself a ton of time and headaches when filing your taxes. But if you're still a little wary of filing your own taxes, there are lots of services out there that can help you. In the next lesson, you're going to learn about the benefits and drawbacks of choosing to use a tax filing service to assist you in filing your taxes. See you then!